I'm Angeline Ong and welcome to our special series on IG on trading mistakes. We're going to talk about gaps. Investors who are quite new to the game often think that gaps should be closed at some stage, but that is not always the case. And we're going to talk about this now with senior market analyst Axel Rudolph. So what are the common mistakes?
Well, basically, as you just said, Angeline, that gaps don't always get closed. So if I show you this example of cotton, for example, you can see here that we have a big gap. And a gap basically is when the candles don't touch each other or a bar chart doesn't get closed. And here we can see that we had actually two gaps. And then on this day here, the first gap got closed. And then if we move along a few days later, the second gap got closed. So in this case, yes, the gaps did get closed, and the reason for this is these gaps are probably just what is called exhaustion gaps at the end of a movement. And what you then also have is what is called a measuring gap, which normally happens in the middle of a movement. Here we don't have one. And then you have what is called a breakaway gap. And if I go on and move the chart forward, we can see here that we have a small breakaway gap. We don't know that obviously at this stage. So if you think that the gap will get closed here and you go short, expecting this gap to get filled, well, you could have been in for a surprise, because that was back in November of 2022. And look, we are now trading in June of 2023, and so far the gap has never been filled. So that is the danger basically with gaps. You need to know which gap you're talking about, which gap is likely to be the one you're looking at. Is it going to be a breakaway, an exhaustion, or a measuring gap? And then according to that, you can trade that signal or that pattern.
Is there a way, an easy way of pinpointing which type of gap it is?
There is no easy way, except if you see a fast up move as the one we just saw on cotton, and you have a gap at the end of the movement, and then the volatility drops off as it just did on that chart, quite often that is an exhaustion gap because the trend is exhausted. With a breakaway gap, it's at the end of a down move quite often, and the market then breaks away and you have a new bull market, or it could be the inverse. But that you don't know at the beginning, because you don't know whether it's a measuring gap in the middle of a long movement or whether it's the end of the trend. So you have to look at other indicators such as oscillators, the RSI, fast stochastic, slow stochastic, or MACD, or things like that, to perhaps tell you whether the trend is likely to end or not, or at Elliott wave theory. But that makes it far more complicated. So yeah, it takes a bit of practice basically.